Today's podcast is brought to you courtesy of our friends at Tuttle Capital, who not only create defiant ETFs for the market, but help investors choose better, navigate smarter, and rest easier. Tuttle Capital, the antidote to Wall Street.
All right, joining me is Ben Werkman, Chief Investment Officer at Swan, which is the #1 Bitcoin-based wealth platform in the US. And I'll certainly have Ben explain this, but they work with both individual investors and with institutions, including helping companies pursue Bitcoin Treasury strategies, which we will be discussing in pretty good detail today. But I would say what's particularly unique about Swan is that Bitcoin is what they do. This is not a crypto-based wealth platform. This is a Bitcoin-based platform. And so, Ben, it's a pleasure to connect. Welcome to the podcast.
Absolutely. Thank you for having me, Nate.
All right. So I know that many people involved with Bitcoin are already familiar with Swan, but I'll tell you, Ben, the crypto prime audience spans a fairly wide swath. So we have TradFi, DeFi, people in between, and I just don't want to assume anything here. And so let's start by having you explain what Swan does. Just take us through some of the primary areas of business.
Absolutely, yeah. And you highlighted one of the main components, which is we are Bitcoin, not crypto. And you'll see that posted out from the Swan handle out there on X if anyone's familiar following that. But yeah, so we are a Bitcoin-based wealth platform. And what that means is we're helping individuals and businesses integrate Bitcoin into their financial lives. And that comes through several different product offering areas. It comes from brokerage, where you're just acquiring Bitcoin. It comes from products like our Swan Vault, which helps you with the custody of your Bitcoin. There can be a lot of complexity that makes people scared of taking custody of their own Bitcoin. But we have a product there that can help and walk them through getting that set up. We also have products like the Swan IRA, so you can acquire Bitcoin in a tax-advantaged account. And then we have our Swan private offering. So for people who are nervous or for people who really like the feel of having a financial advisor behind them like they have in their traditional accounts, we have Bitcoin advisors. So our Swan private team is ready to help walk people through the process of setting up and accumulating Bitcoin and getting that structured in the way that's most advantageous to them.
And why the specific focus on Bitcoin? Because as I was looking through everything that you do, it seems like you could fairly easily apply that to other crypto assets. And so why stay focused on Bitcoin?
You know, Bitcoin solves a fundamental problem that impacts everybody. And when the use case of an asset is well defined, it's something you can stand behind confidently. So with Bitcoin, when you're fighting against monetary debasement and inflation and effectively the erosion of the value you're creating through your efforts, through your jobs that you're trying to retain through your savings, you know, Bitcoin has a use case that's applicable to everybody, individuals, businesses. It impacts everybody's lives. And so at Swan, we took the stance that that's something that's important enough that it deserves your full focus and your full attention. There's going to be a number of other assets that get launched out there, and they're all going to have beautiful marketing about what problems they're solving out there or what their application is. But there's no bigger issue impacting people's lives today than the loss of value of the assets that they're holding. We're seeing costs rise at an astonishing pace. You know, wages aren't keeping up with that. And because of that, people need to be really intentional about the way that they protect the value they create in their day-to-day lives. And one of the ways to do that is to integrate an asset that has a truly finite and fixed supply, like Bitcoin, with just 21 million that will ever be created. So if you're trying to offset the debasement impacts of a fiat currency that has an unlimited supply and that they're going to continue to issue more of into the market in order to maintain the economy, if you want to opt out of that system and protect the value you're creating, you need something that's truly decentralized with a truly fixed supply where there's no more of it that's going to be coming out there. So at Swan, we made it our mission to focus on that, focus on the foundational element that impacts both individuals and businesses' lives and make sure that we can make that a very seamless experience for them so that it's easy for them to start protecting themselves and not complex.
And so with what you just laid out there with Bitcoin, and I thought that was well articulated, is that how you like to boil down the investment case for that asset? And I'm sure we'll talk more about this as we get into corporate adoption of Bitcoin, but just why should investors own Bitcoin in a portfolio or consider owning it?
Yeah, it is. It's very similar the way that I would phrase that, because I think no matter who you are, no matter what your situation is, you can look around you and you can see the impacts of what happens with the active management of fiat currencies, right? When you have an economy that's based on consumption and consumers continuing to spend, one of the things that they need to focus on managing is the understanding that the dollars you're holding today are going to buy you less tomorrow. So you should be using them to consume today. That's part of being in a consumption-based economy. When you look at an asset like Bitcoin, you can have the opposite approach. You could say if this asset is going to be denominated in that fiat currency, which is going to debase forever, but the asset that I'm holding has a truly finite and fixed supply, when the supply can't give, the thing that can give ultimately is the price. And so for people that are trying to protect that value they've created, to protect their purchasing power, they need to opt out of that traditional system. They need to acknowledge the weakness that they see, and they see it every day. Every time you go to the grocery store, you're seeing the impact of what it means to try to continue to keep an economy growing. And they have to stimulate that, and they have to try to do that by ensuring that you're going to spend those dollars you're holding today. So moving to an asset like Bitcoin is something where you can retain and store that value for a very long time and protect yourself from those impacts. And, in the investing community, I would say that we're all rather privileged. We take for granted that, we can invest and we can buy assets, right? The equities markets has traditionally performed well because it gets all the benefits of that debasement of the currency. It flows down to the financials of these corporations whose stocks we own. But a lot of people on Main Street can't afford to make investments right now, right? They're hardly getting by. And so they need to be very intentional in the way that they're storing and protecting that value that they're creating. And because of that, I think an asset like Bitcoin that has a very clear and definable use case creates a niche in the portfolio that everyone should be considering, because this isn't a problem that's going away. If you look at the national debt, you just see it continuing to grow. You see spending bills continuing to come out. I don't think this genie is getting put back in the bottle. So you have to be proactive in the way that you start protecting yourself and you start protecting your family's financial future.
As you walk through that, now I'm very curious, what's your Bitcoin origin story? Like, when did you first become interested?
Yeah, so believe it or not, the first time I ever saw Bitcoin was in a newspaper. And this was back in 2013. So, I know newspapers are already going by the wayside here. So some people might not even know what I'm talking about. But it was back in 2013 was the first time that I saw it. I think it was around November. And I was visiting with my dad. And we were reading through the article and we were talking about going, this is an interesting asset. I don't know what it means. I go, but we should buy 1,000 of them and just see what happens. Now, we didn't do that. It's one of those times you look back and go, man, did we have the right idea, but we didn't execute on it well enough. But I did start trading with Bitcoin back in 2013. I think the very first time I was ever able to buy it was like $264. So again, one of those in hindsight, you really wish you knew what you had. So I traded in it for, about a year before I finally figured out, what the actual long-term value proposition of Bitcoin was. And as soon as you flip that switch in your mind, it completely changes. You're no longer using that as one of the assets that you want to trade. It's an asset that you just want to one-directionally accumulate. So by about the time 2016 rolled around, I'd righted my wrongs and, now you're in the constant quest to get back the Bitcoin that you sold at absurdly low prices back in time. And ever since then, it's just completely captured my attention. And everything that I've focused on for the last several years, I did build trading platforms that were trading with all kinds of digital assets and helping family offices and high net worth individuals with trading strategies. But along that path, I kind of became a public equities analyst because I realized early on that nobody was really covering the story that was happening with strategy. It kind of got dismissed early because it didn't achieve massive success out of the gate. So I decided later in my career that was where I was going to focus. I wanted to focus on this shift in corporate finance because it was one of the few really interesting things that I saw emerging into the market, and I wanted to be a part of telling that story.
I'm glad you mentioned strategy. I think this is a perfect segue to talk Bitcoin treasury companies. And as you're alluding to, this is an area where you obviously spend a lot of time. You and Swan are experts in this space. I feel like you've positioned yourselves as a key on-ramp for corporate Bitcoin adoption. And clearly this is very topical right now, right? There's a lot of buzz around companies buying Bitcoin. I guess first, Ben, just to set the table here, can you explain what a Bitcoin treasury strategy is? And then I'd love to also have you explain how that compares to what you refer to as a leveraged Bitcoin equity strategy, an LBE strategy. So just at a high level, explain those two.
Absolutely, yeah. So Bitcoin treasury companies really, I would say, exploded onto the scene. I'm going to say in the last 12 months. Strategy's been around since August of 2020 with this strategy. They were the first ones. They were the pioneers that decided Bitcoin was going to become their corporate treasury reserve asset. And since that time, after we went through kind of the bear cycle where the strategy didn't seem like it was working, in the last year, it started working incredibly well. And you saw with their most recent earnings when they're reporting a $10 billion net income, that captures headlines and it also captures imaginations. But as a part of that longer term success, more companies have started looking at adopting Bitcoin as a treasury reserve asset. And what that effectively means at the base level is that you're going to change the asset you hold primarily on your balance sheet. So if you're holding US dollars today or US treasuries today as your corporate reserve asset, you're making the shift for either a small allocation of that or a full replacement of that, and you're now holding Bitcoin on your corporate balance sheet as your reserve asset. So when we talk about Bitcoin treasury companies, I view that as a very broad category. To me, that is just any company that decides they're going to hold any amount on their corporate Bitcoin treasury. It might mean that they're taking 1% of their treasury reserves and allocating that to Bitcoin as a hedge, or it might mean that they're doing a full replacement. But to me, any company that's holding Bitcoin on the balance sheet is a Bitcoin treasury company. Now, when we talk about leveraged Bitcoin equities, that's a very different category. And those companies are actively seeking to accumulate Bitcoin by using leverage and deploying intelligent leverage. Now, when you become a leveraged Bitcoin equity, the core KPIs and the way you're measuring success of your business changes. So with a traditional equity, people are going to be looking at, what is the net income of the company? They're going to be looking at forward earnings expectations. They're going to be looking at PE multiples. When you become a Bitcoin treasury company or a leveraged Bitcoin equity, you're now focusing on Bitcoin per share. So what you're doing is you're actively out there using the capital markets and several other tools, and we'll talk about a few of these in a minute, where you're undertaking transactions that result in the asset backing each of your shares increasing. So if Bitcoin is that primary asset on your balance sheet, you want to be able to increase the Bitcoin per share that your company is holding. And that's how your investors start to measure success. So this becomes more of a balance sheet strategy than an income statement strategy. And because of that, it changes the way that investors have to think and really analyze these companies. And there's been a huge amount of new metrics, and I won't make your audience learn all of them today, but there's two primary metrics that people are looking at now, which is Bitcoin per share and Bitcoin yield. And Bitcoin yield is how quickly or how much is that company growing the Bitcoin per share quarter over quarter, year over year. And that's how you determine whether that management team is being successful in achieving the stated goal of that organization. So it's a fundamental shift for those types of companies. Now, when you look out there in the market, one thing you see is that there's a wide range of companies that are now becoming leveraged Bitcoin equities. The first one was Strategy, and that was really a story of a zombie company that had tried everything they could to reignite interest in their equity, to position their products against their competitors. Obviously, they were competing against giants like Microsoft. And Michael Saylor had to ultimately make a decision, and I love the way that he put it. He said, at a certain point, we had to decide whether we were going to die or whether we were going to fight. And he decided he was going to fight, and so he reinvented the core of that business into a Bitcoin treasury company and ultimately into a leveraged Bitcoin equity. And so the rest of the market has been digesting that path and seeing what worked for that company. And as a part of that, because you saw the success and the reinvention of a zombie company, it started to capture the attention of other executives at other zombie companies who started to look at, is this a strategy I could deploy to create value for my shareholders as well? And so you saw the emergence of other companies like Semler Scientific, and you saw Metaplanet emerge, and several others have popped up along the way. And what you're starting to see is this emergence of companies that have executives with a long-term belief in Bitcoin, where they see immense value in acquiring as much Bitcoin as they possibly can on behalf of their shareholders and making sure that they're constantly focusing on long-term value creation through the increment of Bitcoin per share. So it's been a massive shift out there in the markets, and I think it's been one of the biggest stories in corporate finance. But for a lot of people, they're just becoming familiar with it because really you do need to start with that foundation of Bitcoin, understanding the Bitcoin thesis and why this is an asset that a company would want to capitalize themselves on before you move to that next step of saying, now that I understand Bitcoin, how can I find ways, or what companies can I find that may provide me with the opportunity to actually outperform Bitcoin? And that's the goal of these leveraged Bitcoin equities.
You alluded to some of the tools that these companies may use to implement this strategy. And I know listeners of this podcast will have heard of things like convertible bonds and at-the-market offerings. We don't need to get into the weeds, but can you talk a little bit more about some of the ways that these LB strategies are being executed?
Yeah, so strategies really define the playbook for most companies. So if you follow the path that a company like Strategy had, it starts with the initial conversion of assets you're holding on your balance sheet. So just a clean acquisition of Bitcoin using cash, getting out of your US Treasury positions. From there, you really saw it evolved. And in the early days, Strategy used things like secured term debt. And I don't think they would ever go back to that now because when you're operating a leveraged Bitcoin equity, you need to be incredibly mindful of risks and minimizing the risks that can take the ability for you to define your future away from you. And secured term loans are one of those because they come with clauses like liquidation clauses for loan to values or debt service coverage covenants. There's several different clauses that can be in those loans. From there, they moved on to the convertible bond market. And what they found was that the volatility that Bitcoin drives into your equity, right? So when your balance sheet is nearly 100% comprised of Bitcoin, your equity starts to adopt those characteristics of volatility. Your company value is going to move as the price of Bitcoin moves. So it creates an equity that's going to be constantly moving in price, both up and down. And so they found a market where there was a high demand for that type of movement. And that was the hedge funds that were convertible arbitrage desks, right? They're trading the bond paper against the equity and they're implementing, gamma trading and delta hedging strategies. And they found that there was a huge amount of demand because if that underlying equity is a, 70, 80, 90 vol asset, and traditionally these convertible arbitrage desks would have to buy bond paper in a company that might be 20 to 30 vol if they were lucky. You can imagine what that does for the speed at which they can generate their returns. There's a lot more trading activity that they can undertake. And so because of that, they found huge demand. They were able to start raising capital at a premium to what their common stock was trading at. And that was really the primary tool they used to initially scale this. But there's a shortcoming that comes with convertible bonds. One is you've got a lot of shorting activity in your common stock equity. So as you start scaling up, you can get a lot of short pressure coming on, particularly during the pricing periods of these convertible bonds. But what you really have is you have a maturity risk, right? You have a date out there in the future where these bonds are going to mature, and you're now responsible for addressing that maturity. And whether that means a principal repayment if it doesn't hit the conversion triggers, or whether you need to roll them out into the future, right? You have decisions you have to make further out in the future. And so when you have that, it introduces one level of risk. Now, it doesn't mean that it's a bad risk to take, right? If you have a long-term belief in Bitcoin and the performance of Bitcoin, that's a very reasonable risk to have, particularly if you're allowing yourself a full Bitcoin cycle before any of those maturities come due. But what they found recently was that there's a way that they could do this without any of that principal repayment risk and no timing risk in that portfolio. And that was the shift over to preferred equity offerings. And so what they've been issuing now are perpetual preferred instruments, which effectively means they have no maturity date. There's no point at which that principal needs to be redeemed by Strategy. And it shifts the focus away from the notional value of that debt to the annual dividend obligations that they now need to manage. And so it continually changes the model for how you operate a leveraged Bitcoin equity. But with each step, what they're trying to do is find the right tool that's going to increment Bitcoin per share the most effectively and the most efficiently while minimizing the risks associated with the strategy. So that's effectively the progression you've seen so far with these leveraged Bitcoin equities. Now, recently, you're seeing additional types of transactions happening as new companies are trying to enter the market. And primarily, you're seeing that done through PIPE transactions, so private investments in a public equity, which is effectively a straight equity raise by that company. And a lot of times you're seeing that associated with convertible bonds as well. So usually they'll kind of be two-part financings, but sometimes it's just a PIPE transaction. And those transactions are being used by a lot of these smaller companies to achieve scale. There's a benefit to capital raising when you already have a company that has achieved a certain level of scale. So if you can get into the hundreds of millions of dollars, you have more options for how you're going to be raising that capital in the future. For some of these companies raising purely through pipes, it means that they have no leverage on the balance sheet. It was a pure equity raise, so they still have flexibility. But for others, they say, we want to push that dilution in the share count out into the future. So we're going to issue convertible bonds that convert at a premium. So those shares entering the market are going to come at a price that's a premium to what it's at in the market. And so you see company like Sequans or Nakamoto or Strive Asset Management that are coming through that process right now. Some of them have mergers associated, some of them didn't have mergers associated. So there's a lot of nuance. And because of that, it's giving investors a lot to digest. This is a constantly evolving area in finance and in investing. And all of these companies are starting to find ways to deploy the strategy that meets what their own organizational structure is. If you have a company that has incredibly strong cash flow, you might have a different way of deploying the strategy than one that has negative cash flow. So there's a lot of nuance to the way they're going to deploy this, but the benefit of not being the first mover, like strategy, is that you get to look at that history and you get to evaluate what risks were they holding at each point in time and what tools did they get to quick enough that were most accretive to Bitcoin per share. And you can now structure your long-term strategy to try to maximize the impact from the very start to how you can build Bitcoin per share. So I think it's going to be very exciting over the next 5 to 10 years to watch how all these new companies entering the market start to perform and differentiate from amongst themselves.
Yeah, and to that last point, just in talking about you're going to have some companies that have strong cash flow, maybe some that don't have strong cash flow. You use the term zombie company, referring to strategy and some other companies that have gotten involved here. What is a prototypical or a good candidate for a leveraged Bitcoin equity strategy? Like if you had to put it in a box.
Absolutely. I think in the early days, it was the most appealing to the zombie companies, right? The companies that had been operating for a long time, they already have their SEC filing history out there. They've already raised capital, have those tools at their disposal, and they still had strong cash flow, but they didn't have any real future growth prospects. And so the market had just evaporated any premium from their equities. I think that one was very much a no-brainer. But I think that as you're starting to see the success of this strategy, you're going to see a lot of different company profiles start to enter this. One, I think, is you're eventually going to see high growth companies that pair high growth with an active Bitcoin Treasury strategy. So they're going to focus on maximizing growth on the income statement, but they're also going to focus on maximizing the value through the balance sheet and the deployance of the assets that they hold over there. So they're going to try to create maximum value from both sides of the financials. I also think that eventually you're going to see more Bitcoin native companies come into the space, where perhaps there's a competitive edge to actually holding a massive reserve of Bitcoin on your balance sheet where it actually improves the operations of that company. And we're still in the early days because we've been watching these regulations start to fall away and watch the friction come out of the system and the risk come out of the system for companies that really want to build on Bitcoin and bring new services to the market. But I think because we're getting through that period, you're going to start seeing the emergence of these Bitcoin native companies hitting the public equities market. And there may be some nuance that comes with those companies that provides a value proposition that some other companies won't have. So I think this is going to evolve. I don't think we know the end form yet where I could definitively say one company is a better candidate than another, because I think the value proposition of each is going to be different. And I really view this market as segmenting over time, where you start to see these companies get categorized in different areas, like you would have a value versus a growth in the traditional markets. I think you'll start to see similar separation happen in the Bitcoin Treasury companies, and that's going to allow investors the ability to build whatever kind of portfolio they would like to build with whatever type of risk profile they would like to build it around. So I think it's going to be very fun to watch this mature.
You mentioned Strive Asset Management. As I understand it, you will be joining their board of directors here in fairly short order, correct?
Absolutely. Yep. So once the merger closes, I'll be one of the independent board directors for Strive.
Yeah, and so for people who are unfamiliar, they're essentially forming a publicly traded Bitcoin treasury company. And interestingly, Ben, I had Strive CEO Matt Cole on this podcast. This was several months ago. And I asked him several what I would call devil's advocate questions on Bitcoin treasury strategies, because I feel like that's a good way for people to learn and kind of understand what's going on here. And so if you don't mind, I would love to run some of those similar questions by you, basically in an attempt to help clear up some common criticisms or misconceptions that are out there. And as you know, there are a lot of naysayers around Bitcoin treasury strategies. Okay, so let me run through a few of these. And first, I think the most basic criticism that I hear is that these strategies work until they don't. In other words, what happens if the price of Bitcoin craters 80% or 90%? And you and I might say, well, that's highly unlikely, but it is possible. We've been in financial markets, anything is possible. So we have to acknowledge that. So how do you think about that risk?
Yeah, so Bitcoin's going to be volatile, right? It's one of the primary characteristics of Bitcoin that makes this strategy so appealing. Now, when you look at kind of those black swan style events, what happens if it draws down 80%? This is where you're starting to see the focus shift in these companies in terms of how they're deploying the strategy. So, for instance, in the early days, the focus was purely around applying leverage on the balance sheet. And leverage looks different, like we were talking about early, when you had a maturity risk out there with something like a bond product. It looks entirely different when you're starting to issue fixed income instruments. And with fixed income instruments, your focus really shifts to credit quality. And what I mean when I talk about credit quality is you're focusing on the over-collateralization position of those products that you're launching. So you might have a product in your capital structure that's 10 to 1 over collateralized, where even in a significant drawdown event, you might still be 2 to 3 times over collateralized, which still keeps you as a credit-worthy organization out there where you could still raise capital through that product. You might not be able to raise through your common equity, right? This is where a lot of people view the risk, is they view the primary risk in the common equity. And where the risk comes in there is when the multiple to your net asset value drops down to 1 or below. So raising through the common stock is no longer accretive. But that's really why these companies are focusing on building the resilient playbook out there, right? You need to be able to target different markets with products that are valued on different characteristics, right? Common stock equity is going to be valued based on the Bitcoin holdings, and it's going to be highly volatile and tied directly to the movement of those Bitcoin products. Whereas these new preferred products or these fixed income products are really going to be tied to the yields that they're generating and that they're offering to the market. So it's a different type of valuation that happens there. So those products are meant to be far more stable in the market than the common stock. Now, that doesn't mean that the valuation on those preferreds can't also come down, right? Risk adjusts based on that balance sheet performance. But with the focus in this industry really being on credit quality now and the competition being on the quality of the products that you can issue, there's not a race to see who can become the most levered and who can create the highest volatility on the equity. Someone might, try to take that approach, and you might see a company or two that go down because of it. But for the ones that are achieving the major scale, they're shifting that focus. They're trying to build these treasuries responsibly where they're massively over collateralized. They can withstand huge drawdowns. And Saylor just got the question about 80 and 90% drawdowns. And he talked about how they still have, decades worth of coverage on all of the annual dividend obligations, even in an 80% drawdown. So they're building a very resilient balance sheet. So you will see, stock performance obviously is going to be impacted, right? When you're tying your equity to volatility, you can't view volatility as the risk that it's traditionally been pegged as. You're viewing that as the opportunity that creates the long-term value. But it means that if you do see those drawdowns, you need to build your treasury in a way where you're resilient and you can ride out those drawdowns. Because if it happens like it happened in the past where you have bad actors that blow up, that's something you need to ride out while the market stabilizes it. Now, to your point earlier, do I think that's going to happen? Less and less is the answer. It used to be the Wild West out here. I mean, there's no way around that. This was an industry that was built on speculation in the early days and high leverage traders and companies that, behind the scenes were swapping the same collateral around and, creating $100 out of $1. And then it turned out, they were all naked, and you watched the industry kind of blow up periodically. But now the people that are getting involved are companies like Fidelity, right? These are huge names, huge regulated institutions that are not going to be taking the same level of risk because they can't. These are closely monitored organizations that have regulations in place. So I think we're structurally building a different market than we had in the past.
But it sounds like, if I were to summarize what you just said there, when we're talking about Bitcoin treasury companies, in many ways, this comes back to corporate finance 101. In other words, having a resilient balance sheet, theoretically having positive cash flow so you can weather big drawdowns in the price of Bitcoin. It's having a resilient company overall, which makes sense to me.
But you need to start building that at the foundation, because
Right.
you never know when those events are going to hit, right? If we all had a crystal ball, we'd all be out of the game pretty early and retired, but nobody knows. You don't know what the triggering event's going to be. It can be a macro event, right? It can be a global event, right? Bitcoin's a global asset. It's not just in the United States. And so there's a lot of things that can shake people's conviction. And so as a leader of a corporation, you need to be planning for that well in advance and putting that focus on resiliency right out of the gate.
All right, continuing on with my devil's advocate questions here, I would say perhaps the most prevalent criticism that I hear around Bitcoin treasury companies, and I'm really, again, referring to leveraged Bitcoin equity strategies here, is that new investors who are buying the company's shares at a premium are basically subsidizing the Bitcoin yield, which you mentioned earlier, for existing shareholders. So let's say Strategy is trading at an MNAV of whatever, 2. New investors are basically just helping the existing investors acquire more Bitcoin. And again, all of this only works if the price of Bitcoin keeps rising. So I hope that makes sense. How would you respond to that?
It does, yeah. And that criticism's been around for a while, and it started to spawn a lot of new metrics as well, right? People are now looking at metrics that look at how many days would it take to cover the premium to effectively earn that premium back. But I would look at any traditional equity much the same way, right? What are you buying? You're buying the future expectations of that business. For most companies, you're not buying a strong and resilient balance sheet that's filled with an asset that can continue to perform for you and for your shares long out into the future, right? You're buying the expectation of future cash flows. And so when I look at these Bitcoin treasury companies, you're doing something similar, but what you're buying into is that future Bitcoin yield, right? Those are the earnings of these Bitcoin treasury companies. And they're doing something you can't do with Bitcoin that you're holding yourself in cold storage, which is taking the assets and generating more of that asset. So over time, these companies are generating what I and many other investors would consider earnings through Bitcoin per share, right? They're continuing to build that asset base that is backing my shares. And I'm looking out into the future, 5, 10 years. And you have to come up with your own forward expectations for, what do I think that Bitcoin yield is going to look like over a 5-year or a 10-year period? And do I think that this company is going to continue to accrete value in the metric that I've now adopted, Bitcoin per share, which is different than it is for traditional earnings, where you're looking at the net income or the forward expectation on those earnings. So I understand why people look at that criticism. And I also think it's why a lot of people started rotating from companies like Strategy into the new emerging companies, right? There's the value proposition in the early days on a lot of these, where you get that, I'll call it a hyper growth curve of Bitcoin per share, or the Bitcoin yield. And they're generating Bitcoin yield very quickly because they're starting at very small scale. And so they're replacing that premium very, very quickly. Whereas for companies like Strategy that achieve massive scale, right? I mean, they're a $100 billion company plus, that slows down over time. But they have advantages, right? Because they're one of the most resilient companies out there. They've gotten into markets that nobody else has. They get to be the first leader at launching products and scaling products in this preferred market that continue to give them that ability to accrete Bitcoin per share to the common stockholders. And so because of that, you're looking at, do I believe this team and this management team in particular can continue to build Bitcoin per share for me and generate Bitcoin yield? And that is the type of earnings I'm focusing on. And that's what I want my returns denominated in, is Bitcoin.
you may have just answered the next question that I have, or another common criticism that I hear. And I think this is a pretty basic one, but it's that common shareholders are last in line, in the sense that if, let's say, the price of Bitcoin again craters 80% or whatever, there are layers of other investors in front of common shareholders. You have secured creditors, unsecured creditors, etc. And all of them would have a claim to any Bitcoin that's held by the firm before the equity holders. The point being that if you are a common shareholder, the naysayers would say, well, look, you don't really own any Bitcoin. And they would say, if you truly believed in Bitcoin, why not just own it direct? I think you just answered that with what you walked through on the previous criticism, but do you want to comment on that?
Well, I'd start by saying you should own Bitcoin, right? I view Bitcoin as being the foundational element of these portfolios. And you're starting to see investor portfolios shift as the issues that we have in the existing system really start to get highlighted over time. So I always tell people you should start with Bitcoin. One, because you need to build that conviction for yourself in Bitcoin as an asset. You need to understand the problem that it's solving. You need to understand the unique characteristics of being able to actually self-custody an asset that's fully within your control. You need to understand what it means to have an asset with a truly fixed supply that's completely decentralized. It's not tied to any one nation. I think that's incredibly important before you ever venture into an investment in a Bitcoin Treasury company. I view Bitcoin Treasury companies as being much higher up the ladder there. This might be 10 or 15% of that type of a portfolio, where Bitcoin might be, 50, 60, 70, 80% of that portfolio. This is the play portion where you're going to try to outperform Bitcoin with it. But to me, you want to hold the foundational asset that makes all the rest of this possible, right? That is the core thesis. So I don't tell people that you should go and invest all of your money into Bitcoin Treasury companies. I think participating in Bitcoin, participating in the network, running a node, putting a miner, I think participating in everything Bitcoin has to offer is a huge first step. And you need that conviction first before you're truly going to be able to understand the power that these Bitcoin Treasury companies bring. And it does give people a lot of different ways to access Bitcoin exposure, which I think is good, because a lot of people have investments through brokerage accounts. And so they're not taking that out of retirement accounts and moving it into spot Bitcoin necessarily. So it does give a lot of people a way to participate early on if they so choose. But common stock is always going to be the riskiest in the capital structure, right? There's a reason you get the returns, and that the common stock is going to move more than these preferred products are, right? You don't get higher returns for less risk, right? So the risk always falls to the common stockholders. So that's true of any company that's issuing any of these products. So yes, is it true that in a complete disaster scenario where there's a liquidation of one of these companies, that the bondholders would get paid out first, and then the pref holders would get paid out second, and the common stock gets whatever's left? Yeah, that's the reality of how these capital structures work. But you're also accepting that risk into your portfolio, and because of that, you're expecting higher returns to be generated for you.
All right, I'll throw one more negative or skeptical comment that I hear at you. So Ben, I keep hearing this refrain that Bitcoin Treasury companies are a bubble, that everyone is trying to jump in right now. And so I think that gives particularly TradFi investors who may be a bit more contrarian or just don't believe in the crypto space or Bitcoin space overall, it just gives them some pause. And so it's easy to say, look at what's going on over here. This is a bubble. How do you think about that? Or what would you say to that?
I think people drastically overstate the scale of this entire industry. So if you look at, there's 161 publicly traded companies that have Bitcoin on the balance sheet right now. 88% of that Bitcoin's held in the top 10 companies of that list, which tells you that there's a huge amount of room for people to participate. I look at strategy dominance much the way people look at Bitcoin dominance in the crypto ecosystem. And strategy is about 66% of the total holdings out there for these companies. So, I look at it, and while you might see a lot of headlines that are talking about a lot of companies adopting this, what really caught me was that we actually went backwards in terms of how I thought this was going to play out. I thought that this was going to play out with the companies adopting it slowly as a hedge, where they would take a 1 to 5% position and they would start putting it on the balance sheet that way. But Strategy came out and decided they were going in with both feet and highlighting the power of what happens when you adopt Bitcoin as a core part of the way your company operates. And because of that, it generated so much interest in this leveraged Bitcoin equity play that you're now seeing more and more companies coming out and trying to replicate what Strategy has done. I still think that the initial, right, that first hedge position, I think that's what's going to start emerging over time. And that's one that, people might have gotten scared away from because of all the excitement around the Bitcoin Treasury or the leveraged Bitcoin equity companies, where they may have had some pause. But I think it's going to become undeniable that as a corporation, you need to start protecting the value that your business is creating from the debasement problem. And because of that, I think we'll start seeing more and more companies start adopting it without any of the plans to go and leverage the capital markets activities to try to accrete Bitcoin per share. They're just going to hold it on the balance sheet to strengthen the resiliency of that company. And I still think that's coming. And I think that that is a very significant market yet. So yeah, you see a lot of announcements coming out probably in the last 3, 4, 5 months, but it's all very small scale. Most of these companies are still in the low hundreds of Bitcoin, right? It's not overly significant. And when you look at the size of the market that these products that these companies are launching are trying to tap into, you're talking trillions of dollars and hundreds of trillions of dollars. So there's a huge amount of room to go. Strategy is really the only player of any real significant size at this point. And so to me, I think we're still just at the starting line, and this is just going to speed up, not slow down.
Yeah, and so talk more about what that looks like, because clearly you're bullish here. Is it as simple as we're just going to continue to see greater corporate adoption of Bitcoin by larger and larger companies? We're going to see name brand companies that everybody knows starting to adopt Bitcoin, and we have this overall further mainstreaming of Bitcoin. Is it that simple?
I think in the long run it is. In the early days, and Saylor said this several times, right? People find Bitcoin when they need to find Bitcoin. And the problem for a lot of these larger companies is they don't feel they need Bitcoin yet, right? They're already strong companies. A lot of them have strong balance sheets. They're built on US dollars. Those are melting out from under them, but they have strong balance sheets. So to them, going and investing in an asset that, is in the $2+ trillion market cap range, isn't significant enough for them yet. They don't quite see the risk. It's not existential to their business. They're not watching that value erode away because they're one of the companies that's in the lead at the moment. However, what I start to look at is the pace of disruption that's entering the market, right? AI is an incredibly powerful tool. And I think that we're still underestimating how many industries and how many corporations AI can disrupt by newer players entering the market that are smaller, more efficient, haven't built up all the overhead of these legacy companies. And there's no company that's above disruption. And because of that, I think as a corporation, you do need to proactively plan for the day where disruption might show up at your door, and you might need to be ready to reinvent yourself. And I'm not saying they're going to reinvent themselves into Bitcoin treasury companies, but what I'm saying is they want to build the war chest so that when wartime comes, they're ready to entrench themselves and move on to whatever it is that's going to be the next evolution of that business. So focusing on the balance sheet, building strength, not, running things on a razor's edge and making sure that you don't have capital available to sustain a period where you may see a drastic impact to your business, I think is very prudent for leaders these days. And because of that, I think that that's going to start to be part of that narrative that drives companies to start looking at allocations to Bitcoin earlier rather than later. So I do think that's coming. And I do think you will see brand name companies start showing up. Tesla's a brand name company. They've got it. Now, they didn't get all the love from the Bitcoin community. And I'm not sure we did ourselves any favors with that one, right? I mean, we're rather rabid and passionate bunch. So when they sold Bitcoin, they got a lot of flack for it, but they still hold more than 9,000 Bitcoin on the balance sheet. Still a very significant position. So we do overlook the fact that there are already some brand name companies that are holding it, but I think we're going to see a lot more.
Well, Ben, I think that's the perfect spot to end our conversation. Just an excellent tour through corporate adoption of Bitcoin. Great to connect. And I really appreciate you taking the time this week. Thank you for joining me.
Absolutely. Thank you for having me, Nate.
That was Ben Werkman, Chief Investment Officer at Swan. Hope you enjoyed this episode of Crypto Prime. I want to thank our sponsor, Tuttle Capital. If you would like to learn more about Tuttle Capital's ETF lineup, you can visit tuttlecap.com. For exclusive daily market insights and the playbook that Wall Street doesn't want you to see, subscribe to Tuttle's free newsletter at theheatformula.beehive.com/subscribe. See you again next week.
Crypto Prime is hosted by Nate Geraci, president of OTR Media LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. Some guests appearing on this program may also be financial sponsors of Crypto Prime. This program is for informational purposes only and does not constitute investment advice. Investing in crypto assets involves substantial risk, including the possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Visit CryptoPrimePodcast.com for more information.